Australia's AAA credit rating was affirmed yesterday by S&P Global Ratings, which says Australia's level of net government debt is lower than most of its advanced economy peers and will likely remain below 30% of GDP. But S&P do flag some risks to the outlook, including commodity prices and a blowout in the government deficit. For more on this, I'm joined by Martin Fu, Director and Lead Analyst at S&P Global Ratings. Martin, thanks for your time. Look, let's just start with, is it a small number of countries still that have a AAA credit rating? It must be a pretty small group.
G'day, Ed, and yes, that's exactly right. So yesterday we affirmed the AAA sovereign credit rating on Australia. It has been AAA for a couple of decades now, and by our measures, it's one of only 11 countries out of 137 that we rate that carry this pristine gold-plated AAA rating.
Yeah, just explain the positive signs you're seeing in Australia's economy to reaffirm that rating of AAA.
The AAA rating reflects a lot of long-term enduring strengths of the Australian economy and the Australian credit profile. For instance, its wealthy and diversified economy, strong political institutions, credible monetary policy, and relatively low net general government debt, like you mentioned at the outset, Ed. We do note that there are, some headwinds. The economy has decelerated significantly. GDP per capita has tracked backward for the last couple of quarters. So there are some pretty significant headwinds. We do acknowledge that. But these strengths that we've seen persist for a very long time have given us comfort to affirm the AAA rating.
Yeah, one big strength has been the commodity prices been pretty strong. Look, iron ore in particular has had a good week just in the last 7 days or so, but you put that in there as a potential risk going forward, that if there is a collapse in commodity prices, I mean, how much could that damage our economy here in Australia?
Look, commodity prices have been elevated over the last couple of years, but they've also been volatile. And it's sort of a mug's game to try to predict where they will go in the future. But in our base case scenario, we do expect iron ore spot prices to level off at maybe around $90 per tonne. And that's considerably more optimistic than where the Commonwealth Treasury has pegged it, which is more like $60 per tonne. But there are some downside risks to commodity prices, as there always have been in the past. We have noted in some of our recent reports that Australia's exceptionally strong fiscal result for the fiscal year just ended, so the June 30, 2024 year, was largely propelled by commodity prices. These have translated into strong corporate tax revenues at the federal level and into strong mining royalties for places like Western Australia and Queensland. And that's helped smooth over or paper over some of those emerging structural spending pressures. So those strong commodity prices have certainly been a tailwind to the credit rating, but they probably are not going to last forever.
Yeah, what about Australia's fiscal deficit? I mean, where are you expecting that to go over the next couple of years?
So when we look at the deficits, we do look at the tally of both the feds and the state and subnational governments. So for the federal budget, as you might be aware, Ed, the result for the fiscal year just ended is likely to be pretty strong. At the time of the May budget, the Treasury was pegging the deficit at around $9 billion, the underlying deficit. And we wouldn't be surprised if the outcome is actually a few $billion stronger than that. But then when you look across the forward projections, there is a very dramatic turn in the fiscal stance. And we expect headline deficits of somewhere in the order of $40 to $50 billion per year over the next couple of years. Of course, when you combine that with the states and what's happening at state government level in terms of very considerable infrastructure investments, the overall consolidated deficit looks a little bit worse. So for the fiscal year just ended, we thought we projected the general government deficit at about 0.8% of GDP. But we expect that to roughly double. So we're projecting consolidated deficits of around 1.5%, maybe 1.7% of GDP over the next couple of years. The reason this is happening, Ed, is a number of factors. One is the recent deceleration of the economy. Secondly, it's the slightly weaker commodity prices in the last 6 months. And thirdly, it's new and emerging, as well as structural spending pressures. So we saw the federal government roll out pretty significant new cost of living relief to the tune of about $7.8 billion in the May budget. And you put that on top of these underlying structural spending pressures. We see interest outlays growing at about 10% per year in nominal terms, defence spending maybe 6.6% per year, national disability insurance maybe 8 or 9% per year. And you put all this together and it does lead to a widening deficit in our base case.
And look, Martin, this week there were the inflation numbers came out yesterday, 2.7% now, headline inflation. How far off do you think the Reserve Bank is from cutting interest rates?
The 2.7% print was a positive and promising development. It was roughly in line with market expectations, but it's a big improvement over what we've seen in recent months. And it's the first time that headline inflation has been within the Reserve Bank's target range of 2 to 3% for a couple of years, I think since 2021. However, we have noted that underlying or trimmed mean inflation remains pretty sticky at about 3.5, 3.6%. And that means the Reserve Bank's not going to be in a rush to cut interest rates. So Martin, in our base case, we don't expect the... Yes.
Sorry, we've run out of time, but sorry, in your base case, you don't expect a rate cut until 2025? Yeah.
Yeah, that's right. So 2 rate cuts in 2025, but nothing for the remainder of 2024.
Great. Thanks, Martin. Thanks for coming on the show.